Silver just pulled back roughly 15% after touching $83 an ounce. And that kind of move immediately raises a serious question. Not for traders chasing headlines, but for investors who've watched multiple cycles. Was this the top or just the market doing what it always does before the next leg higher? Silver just had the best year since 1979, gaining roughly 150% in 2025. It became the third best performing asset class globally, but then we saw a brutal correction, nearly 15% off the highs in a matter of days. So the big question everyone's asking is this: was that the top? Did we just witness the blow-off peak of the silver bull market? Or is this simply a healthy correction before the next leg higher? Today, I'm going to break down the evidence on both sides, analyze what's actually driving this volatility, and help you understand the fundamental forces at play so you can make informed decisions, not emotional ones. Let's dig into the data. First, let's talk about what actually caused this recent price destruction, because understanding the mechanics matters enormously. Within a 2-week period, we saw 2 major margin requirement increases on COMEX silver futures. Let me explain what that means and why it's so significant. CME Group, one of the world's largest commodity trading floors, raised margin requirements for precious metals traders, first by 10 to 15%, then by another 30% on December 31st. Silver got hit the hardest of all metals. Here's how margin requirements work. When you trade futures contracts, you don't pay the full value of the contract. You put up a percentage as collateral. That's your margin. If margins are raised from, say, $22,000 to $25,000 per contract, traders suddenly need to deposit an additional $3,000 immediately or their positions get liquidated. And that's exactly what happened. According to data from the first margin hike on December 12th, we saw 13,430 contracts sold in just 15 minutes. That's not normal selling, that's forced liquidation. When the second increase hit on December 26th, the day after Christmas during thin holiday trading, the carnage was even worse. Thousands of contracts were automatically liquidated as leveraged speculators couldn't meet the new margin requirements. This is what industry insiders call shaking the bushes. The big banks and institutions with unlimited checkbooks can easily meet higher margin requirements, but retail traders using leverage get flushed out completely. And here's the key insight. This has nothing to do with the fundamental supply-demand situation for silver. This is purely a function of exchange rules designed to manage volatility, or more cynically, to shake out weak hands so big money can scoop up contracts on the cheap. The last time we saw this pattern was in 2011 when margins were raised 6 times in quick succession and it killed silver's rally from $50. But here's what's different this time, and why I don't think this is the top. While everyone's focused on the paper price volatility, something far more significant is happening beneath the surface: record physical delivery demands. Let me give you the numbers because they're staggering. In December 2025, COMEX saw delivery notices for 62.875 million ounces of silver, a record high for December of all time. In the first 3 days of January trading, we saw an additional 17.98 million ounces of silver delivery demands. That's nearly 18 million ounces in just 3 days. To put that in perspective, a mint box of silver containing 500 ounces weighs 42 pounds. We're talking about massive physical movements of actual metal, not paper shuffling. Now for gold, December saw 3.706 million troy ounces delivered. The first 3 days of January saw 424,900 ounces, meaning 3 days of January nearly matched entire months from previous years. Here's why this matters. The most well-informed, sophisticated, and well-funded traders in the world are standing for physical delivery of millions of ounces every single month. They're not trading for short-term gains. They're taking possession of actual metal. And this isn't new. This pattern has been ongoing for 15 months straight since the November 2024 election, month after month of record deliveries. Ask yourself this: why would the smartest money in the world be accumulating physical silver at these prices if we just hit the top? These aren't retail investors panic buying. These are institutions with access to the best intelligence, the best analysts, and effectively unlimited capital. They know something the general public doesn't yet understand. Here's where things get really interesting because it reveals a seismic shift happening in global banking. According to reports, including one that was published and then mysteriously pulled from a major financial publication, Deutsche Bank has been forced to deliver 3.27 million ounces of silver in recent delivery periods. And who are the buyers? JP Morgan and Citigroup, the 2 largest derivatives holders in the precious metals market. This is extraordinary for several reasons. First, there are reports that JP Morgan has flipped from net short to net long in silver. That doesn't mean they don't have short contracts anymore. They do, but it means their overall exposure is now biased toward rising prices, not falling prices. That is a massive shift. Second, metal traditionally flowed freely between European banks and US banks. They were partners in the system. But now European banks are being forced to deliver physical metal to US banks. This looks less like partnership and more like cannibalization. Citigroup says they're taking delivery for their house account, meaning for the bank itself. JP Morgan says it's for a client, but what kind of client has the resources and desire to take delivery of millions of ounces of silver month after month? The implications are profound. The smartest, best-connected institutions in the silver market now want to hold actual metal rather than paper promises. That behavior has never occurred at this scale in modern history. When the banks themselves don't trust the paper system they helped create, that should tell you something about where we are in this cycle. Now it's important to separate short-term technical factors from long-term fundamentals, because there were legitimate year-end reasons for selling pressure. One factor was tax considerations. Under Section 1256 of the tax code, gold and silver futures gains are treated as 60% long-term and 40% short-term, regardless of holding period. At year-end, open positions are marked to market, creating incentives to close and re-enter positions. This selling had nothing to do with silver's fundamentals. Another factor was portfolio rebalancing. Silver rose so dramatically in 2025 that it became an outsized portion of many portfolios. Institutions were required to sell to rebalance back to target allocations. A third factor was simple profit-taking. After 150% gains, some early investors chose to lock in profits. That's rational behavior. But here's the key point. None of these factors changed the supply-demand fundamentals that drove silver's rise in the first place. Historically, January is when fresh capital gets deployed. Hedge funds return with new allocations, and institutional money looks for opportunities after year-end volatility. And what do they see? The best-performing asset of 2025, now down 15%. This creates the January effect, where mechanical selling creates discounts for new buyers. Institutions understand this playbook. That's why margin hikes during thin holiday trading can shake out weak hands before stronger buying returns. Now let's zoom out and look at the strategic reclassification of silver. The United States officially designated silver as a critical strategic mineral. The European Union did the same in late 2023. China has treated silver as strategic for years. That means silver is no longer just a commodity or a precious metal. It's a strategic resource essential to national security and economic competitiveness. Silver is required for solar panels, electric vehicles, military electronics, data centers and AI infrastructure, advanced telecommunications, robotics, and automation. When governments classify a resource as strategic, demand becomes structural. Stockpiles are built, exports are controlled. This is not speculative demand that disappears overnight. Does that sound like a market top or the beginning of a multi-year revaluation? Now let's talk about supply, because this is where silver is fundamentally different. Of the roughly 850 million ounces mined annually, only about 160 to 170 million ounces come from primary silver mines. More than 80% is produced as a byproduct of copper, lead, and zinc mining. That means you can't simply mine more silver when prices rise. Even at much higher prices, supply won't meaningfully increase unless base metal production increases as well. At the same time, demand is inelastic. Industrial users need silver regardless of price. You have inelastic supply, inelastic demand, export controls, government stockpiling, and record physical deliveries. That imbalance is getting worse, not better. Behind the scenes, accumulation is accelerating. China has been buying silver directly from Mexico and Peru in unrefined form, paying premiums and bypassing Western pricing mechanisms. Major industrial players are securing supply directly from mines. Auto manufacturers are now attending mining conferences to lock in future production. When the largest players bypass the spot market and focus on physical control, it tells you price discovery on exchanges is increasingly disconnected from reality. Technically, we're not near historical extremes. The gold-to-silver ratio sits in the mid-50s. The 100-year average is closer to 42. A reversion to that average implies silver above $100 at current gold prices. Even conservative technical models, including long-term chart patterns, point toward triple-digit silver based on historical behavior. We just touched 83 before correcting. That doesn't look like a blow-off top. It looks like a pause in a larger revaluation. So what does this mean for you? If you're holding physical silver, this correction should increase your confidence. The volatility is happening in the leveraged paper market. The physical market continues to show tightness, delivery strain, and accumulation by institutions. If you're considering buying, corrections driven by margin hikes and mechanical selling are exactly what long-term accumulators wait for. Dollar cost averaging remains the most rational approach. If you're a trader, understand that this market is designed to shake you out. Volatility will be extreme, and leverage is dangerous. The real question you need to ask is this: what is your time horizon? If you're focused on next week or next month, the noise will overwhelm you. But if you're looking at 2027, 2028, or beyond, the fundamentals are overwhelmingly bullish. The biggest risk isn't direction, it's timing. Being right with leverage can still wipe you out. That's why experienced participants emphasize physical ownership, diversification, and patience. So, is the silver boom over? Based on the delivery data, strategic designations, supply constraints, institutional accumulation, and historical valuation metrics, my answer is no, not even close. Could we see more volatility? Absolutely. Could silver dip further before the next leg higher? It's possible, but the underlying thesis has only strengthened. The public doesn't understand this yet. Mainstream media isn't covering it. That's exactly where major bull markets begin. My goal isn't to tell you what to buy or sell, it's to help you understand the forces at work so you can make informed decisions. Let me know what you think. Was this the top or just a correction? Are you holding, buying, or waiting? What's your time horizon? If you found this analysis valuable, like the video, subscribe, and turn on notifications. The silver story isn't over. It's just getting started. Stay sharp, stay informed, and remember, in volatile markets, knowledge and patience are your most valuable assets. I'll see you in the next video.